am wearing the bull market socks. The Bitcoin bull is back, baby. And I'm not ready to call it absolutely, but if we surpass 21.9 on this kind of third rally, we've made 3 successive higher lows off the 17.5 wick, and I'm starting to feel like spring is coming. They said, well, there's not a hedge against inflation because inflation was 9% and Bitcoin didn't go up. I'm like, oh, wait a second. In the last 2 years, the Fed, okay, this big spike on the chart, the Fed printed 50% of all the dollars in the history of the Republic, 256 years. Oh, interestingly, okay, if you print 50% of the dollars, that means you basically devalued by 100%-ish, right? Because you've doubled the money supply. Bitcoin's up precisely 100% in that 2-year period.
Hey guys, welcome back to the channel. Today we have hedge fund manager Mark Yusko giving us his outlook on the status of the current bear market. Yusko states that markets don't go straight up or down, they chop, because people are reacting out of greed or fear. Mark says that there are 2 types of markets, distribution and accumulation. Signs of a cumulative market is getting low, then starting to go back up. People get scared, so they begin selling to push it back down, but extra buying pressure causes it not to go as low as it should have, so a higher low is set and it goes up again, causing a cycle that is called bottom rounding. Yusko notes that understanding where a market is at isn't about prediction, but about directionality and pattern recognition. Mark observes that the traditional market still has quite a long way to go, and that the issue is massive amounts of leverage. So many margin debts are in stocks that when corrected are still overvalued. Let's check out this interview with Mark Yusko as he gives us his opinion on the similarities between now and 2001. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
On the positive side, when you have higher lows and higher highs, and because markets chop, right? Markets don't go straight up, they don't go straight down. They chop because human beings react greed and fear. And there are 2 types of markets. Winter and summer are distribution markets, when people are selling, distributing, and accumulation markets, when people are buying. And signs of accumulation are when you get a low and then it starts to go up, and then people get afraid and they start selling and it pushes back down. But then there's more buying pressure, so it doesn't go as low. So you make a higher low, and then you go up again, and then you start to come down, and then you make another higher low. That pattern of higher lows is the formation of, you've heard it called a bottom, a rounding bottom. And if again, people say, oh, drawing lines on charts doesn't do anything. No, it doesn't predict things. It doesn't cause things, but it lets us see patterns of behavior. So again, it's not about prediction precisely. It's about directionality and pattern recognition, and it's just because human beings. The key thing, I sent a series of tweets yesterday about this on the traditional market and then relative to the Bitcoin market. The traditional market, not done. It's got a long way to go, and the problem is too much leverage, right? There's still a mass amount of leverage. We corrected the amount of leverage that was higher than 18, which is orders of magnitude higher than 2008. There's so much margin debt in stocks that needs to correct. And as it corrects, the problem for stocks is stocks are still 54% overvalued relative to fair value. They've only been this expensive 7% of the time. In all of history, 140 years of history, only 7% of the time have US equities been more expensive than right now. That includes the drop this year. On the flip side, Bitcoin has only been cheaper than its long-term history on 2% of the time, 2.5% of the time. Oh, you have my charts.
I do. I do indeed.
That's kind of fun. They're not my charts. They are advisor perspectives charts. Doug Short started it, and Jillian, I can't remember her last name, keeps it going, and they're fantastic. And I love this one, right? The red line, stocks go up. Over the long term, stocks go up. Why? Inflation, right? Our currency gets less good, so the value of assets goes up. Earnings, right? Companies actually earn money. And growth, right? There is economic growth. So those three things make that red line go up about 6% compounded in real terms a year. And the problem is stock prices reflect greed and fear. And the greed is when we're above the red line, and the fear is when we're below the red line. And you can be above or below for a long time, but we've been above for a very long time. And to get back to fair value requires 54% drop from here. It's crazy.
Yusko says that PE 10, which is 10 years of average earnings, smooths out many of the peaks and troughs. Some people are maintaining the specious argument that the PE should be higher because companies make more in a low interest rate environment. This is incorrect because a low interest rate condition is actually a sign of a weak economy. Mark states that 2000 was a warm-up year as the market only dropped 6%. Then after 2001's rally, it went back to equal. Companies like Cisco couldn't sell their inventory, so they wrote it off and later sold at zero cost, which then led to a discovery of fraud.
This is not PE like today. This is called PE 10. This is 10 years of average earnings, which smooths the peaks and the troughs. And people are saying, the PE should be higher because companies make more in a low interest rate environment. Yeah, that's a specious argument because low interest rates are a sign of economic weakness, not strength. And so your future earnings growth is probably lower. This is 2001 redo. And, I've talked about this and talked about it ad nauseum. People forget 2000 was not the bad year, right? 2000 was the warm up. 2000 is when people went, oh, wait a minute, this is stupid. And we started to go down. But then we had this relief rally where the Fed said, we're going to save everyone and we're going to print more money. Because the Fed had printed $500 billion, one half of a trillion, not 10 trillion, but one half of a trillion leading up to Y2K because they were afraid the world was going to end. And when the world didn't end, people looked at stock prices and went, oh, geez, these are pretty high. And so March 24th, that was the top. But then the Fed came back in that first quarter of 2001 and said, no, we're going to provide liquidity and we're going to save us. And so we only ended up down 6% for 2000. But 2001, when Stan was getting whipsawed, was you had this rally. And we went all the way back almost to equal from, I think at one point down 14, 15%. So it was a vicious rally from kind of the middle of November through December into January, February. And then the stuff happened. All the stuff that Stan describes led to earnings revisions. So famously, and this is also happening right now. So you had these companies like Cisco that couldn't sell their inventory. So they wrote it off. And literally, then they started selling it again later at zero cost, which is just so insane. But they wrote it off and they said, oh, we have to restate all of our earnings from the last 5 years because we kind of exaggerated. And it led to the discovery of fraud.
Mark says that when anyone uses the new term paradigm, there will be a drop that accelerates through capitulation and fear, which then turns to hate of the other side. Back in 2003, before the second invasion of Iraq, everybody was through with stocks and institutions didn't want to invest, which made it a perfect time to buy. Yusko remarks that in 2022, everything is the same as it was before. He says that Bitcoin isn't a Ponzi scheme, but it can be called a pyramid, as it is built on faith, belief, and foundation, just like every other currency in the world. The Fed has in the past 2 years printed 50% of all cash in Republic history, which because the supply has been doubled, devalues the dollar by 100%. This causes Bitcoin to go up by 100% in the last 2 years. What do you guys think about Mark Yusko's opinion on the similarities between 2001 and today? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.